The Bank of Canada just announced that they are increasing the overnight rate by 50 points, meaning the bank's prime rate pricing will be increasing as well. Hello everyone. I wanted to make a video discussing the rate increase that was just announced, break down the Bank of Canada press release, and give my opinion on whether or not this is the time to lock into a fixed rate mortgage. The overnight rate is increasing by 50 points, meaning most banks' prime pricing will also be increasing by 50 points, bringing prime to 5.95%. I'd just like to remind everyone, in variable rate mortgages, unless you don't have a discount on prime, you won't be paying the 5.95%. To get the net rate you'll be paying, you'll need to subtract the discount you have off of prime. So if your discount is 0.90%, your net rate would be 5.05. Does this increase impact you? If you are in a variable rate mortgage, you either have a static payment or an adjustable payment. If you have a static payment, when the prime increases, the percentage of interest versus the principal you'll be paying fluctuates. So your payment stays the same, but your amortization length changes. If you have an adjustable payment, your payments will increase or decrease to reflect the changes in prime. Let's take a look at how this increase will impact mortgage payments. So before this rate increase, prime was at 5.45. With a discount of 0.9, you'd be paying a net interest rate of 4.55. So on a mortgage amount of approximately $494,000, amortized over 25 years, your payment would be approximately $2,748 monthly. Now, taking those same mortgage details, but with a rate of 5.05, your monthly payment will be increased to $2,887. The target range is between 1% to 3% for inflation. We are currently at a CPI of 6.9%. So there is still work to be done, but the Bank of Canada is projecting that the CPI will be down to about 3% come the end of 2023. Before the pandemic, we were hovering around that 1% to 3% target range. Once the first lockdown happened, the CPI dropped negative due to the fact that everything was locked down and people weren't spending their money. The Bank of Canada responds to this by lowering the rate to the historic lows. Once the economy started opening up again, a combination of high government spending, low rates, and high amounts of disposable income due to lockdowns, inflation skyrocketed. Here is a paragraph from the Bank of Canada in their words. Given elevated inflation and inflation expectations, as well as ongoing demand pressures in the economy, the Governing Council expects that the policy interest rate will need to rise further. Future rate increases will be influenced by our assessments of how tighter monetary policy is working to slow demand, how supply challenges are revolving, and how inflation and inflation expectations are responding. Quantitative tightening is complementing increases in the policy rate. We are resolute in our commitment to restore price stability for Canadians and will continue to take action as required to achieve the 2% inflation rate. Based on this statement, I would still expect the overnight rate to rise. If I had to guess, we are done seeing the 75 to 100 point increases unless something globally happens that limits supply even further. The next rate increase is on December 7th, and I'd expect to see an increase of 25 to 50 points. So should you stay variable or lock into a fixed rate mortgage? This is the question everyone was waiting for. If you are really stressing out about these rate increases going forward and are losing sleep over it, my suggestion would be to lock into a short-term fixed rate mortgage, 1 to 2 years at max. The reason being is because I believe one or two things will happen. Inflation will start to ease and we'll see the CPI retreat back to its target range, or these rate increases will tip our economy into a short-term recession. Both these outcomes lead to rates decreasing. If you are locked into a 5-year fixed mortgage and want to refinance to take advantage of lower rates, when they do come down, you'll have a sizable penalty to break it. I do still think variable rates are the way to go, as I think we are nearly the top of the rate hike cycle. So being in that variable rate allows you to automatically benefit when rates do come down without having to refinance. I hope this helped answer some of your questions regarding interest rates. If it did, please subscribe and share with a family member or a friend, as it will help me grow my channel and educate more Canadians. If you have any questions, make sure to ask them in the comments or reach out to me directly. My info will be linked to the description below. Thanks for watching and have a great day.